Welcome back, everyone, to another deep dive.
From AI-inspired insights from farmers.
If you're enjoying what we're doing here, we'd love to hear from you too.
Absolutely.
Hit that like button, subscribe to the channel, and definitely leave a comment telling us what you want to see more of on this deep dive.
We're always looking for new ideas, and we really value your feedback.
So what farm-related mysteries are you dying to uncover?
Right.
What questions are keeping you up at night? Let us know, and maybe we'll tackle them in a future deep dive.
Welcome to the deep dive. Today, we're exploring some of the less obvious, yet really key financial realities of running a farm.
Especially if you're just starting out.
Exactly. We're calling these the hidden hands of farm finance.
Yeah, and our aim here is really to unpack some of these core ideas around borrowing, different costs in farming.
Things you need to get your head around.
Definitely. Understanding this stuff is, well, it's essential for anyone starting up or even just managing a farm. It really affects if you can make it work long term.
So to help us figure this out, we've pulled from quite a few places. We've got analysis from FarmDoc Daily, insights from the Federal Reserve Bank of Minneapolis.
Open markets for market views, info from alberta.ca, and also Produce Pay on the sort of modern financing side.
And the big theme running through all of this, interest rates, their impact in agriculture.
Which is so relevant right now. The financial picture for farming has some big hurdles.
You mean high input prices, farmland costs?
Those, plus interest rates are up. It's a tough combination. It means borrowing is often, well, necessary, but the cost of that borrowing is a much bigger deal now.
Okay, let's dig into the first hidden hand then. Land loan leverage. I mean, for anyone starting out, buying land is usually the huge first step, right? And that almost always means big loans.
Absolutely. And the interest rates on those land loans, they directly and significantly affect how much that core asset actually costs you over time.
Even small rate changes add up.
Oh, massively.
Yeah.
Over the life of a long loan, yeah.
Now, it's interesting. FarmDoc Daily looked back at 2022, and they found that rates on real estate loans didn't really vary much statistically.
Oh, really? Between different lenders?
Yeah, or even between, say, crop farms and livestock farms or different business types. It suggests things were pretty uniform back then, maybe less room to negotiate on the rate itself.
Okay, that's how it looked at. But, the same FarmDoc Daily piece mentioned a Kansas City Fed report saying about half of all farmland loans are going to need refinancing pretty soon, in the next 18 months or so.
Wow, okay. So rates now matter a lot for existing owners.
Exactly. Even if the rate was similar when they first got the loan, refinancing in today's rate environment, that's a whole different ballgame.
That definitely makes things trickier. And we saw this worry pop up in that open markets article, too.
The Nebraska farmer.
Yeah, saying he really had to think hard about interest rates for the first time when planning for spring planting, borrowing for land and other stuff, too. It wasn't just automatic anymore.
And from a bigger picture view, alberta.ca points out interest rates are a major driver of land values. Makes sense, right?
Mm-hmm.
Land is a huge part of a farm's assets.
So higher rates mean borrowing is more expensive.
Which can lower what you expect to earn from the land and, maybe cool down how much people are willing to pay for it. Puts a bit of a brake on land prices, potentially.
Okay, let's shift to the second hidden hand, equipment finance. Just like land, you need machinery, equipment, often funded with intermediate-term loans.
Right, and here, that FarmDoc Daily analysis did find more variation in the interest rates compared to land loans.
How so?
Well, specifically, livestock operations tended to pay higher rates on that intermediate debt than crop operations did. That was across all lender types in 2022.
So your farm type could influence your equipment loan rate.
Seems like it. And FarmDoc Daily also noted that for banks specifically, those intermediate loan rates were higher for livestock farms. And that difference was statistically significant compared to rates from the farm credit system.
Which is the farmer-owned cooperative system.
Right, and compared to vendors, too. So a livestock farmer might get different terms than a crop farmer from the same bank for similar gear.
Any idea why?
Well, the FarmDoc authors suggested it might be about how they use that debt. Crop farms, mostly machinery. Livestock farms could be machinery and financing the animals themselves.
Different kinds of assets, different risks.
Exactly. So potentially different financing costs.
FarmDoc Daily also found banks gave lower rates on this type of debt to the bigger commercial farms.
Compared to smaller operations.
Yeah, compared to rural residents and intermediate farms. And again, that was statistically significant. So size matters too, it seems.
And that connects a bit to Produce Pay, doesn't it? They talk about refinance loans to help buy capital assets like machinery.
Right, often with longer repayment terms, using the machine as collateral. could be really useful if you're building up your assets.
And Alberta.ca brings it back to the basic economics again. Investing in machinery gets less attractive when interest rates go up, especially the real interest rate after inflation.
Makes those big purchases tougher to justify.
Definitely. Okay, third hidden hand, input inflation. We're talking seeds, fertilizer, feed, all the essentials. Costs fluctuate, and farmers often need short-term cash to cover them.
And FarmDoc Daily pointed out the obvious. When production costs go up, the need to borrow goes up too. We've certainly seen crazy swings in input costs lately.
We have. Now, their 2022 data showed for short-term debt, crop farms paid rates about 0.5% higher than livestock farms.
Not statistically significant.
Right. So maybe a trend, but not a definite difference in borrowing costs there, based on that data.
But FarmDoc did find something significant with vendors, didn't they?
Yes. Input suppliers, equipment dealers. They gave lower short-term rates to commercial farms compared to banks in the farm credit system.
So for bigger farms, maybe financing through suppliers is worth a look.
Could be. And that fits with Produce Pay's enablement loans, too. They're designed specifically to cover those input costs during the production cycle.
Kind of like a line of credit tied to production.
Sort of, yeah. Often renewable, paid back when the crop or product sells, aligns the financing with the farm's cash flow cycle.
And the Minneapolis Fed also chimed in here, saying higher production costs from supply issues and just general uncertainty.
Yeah, it might force some farmers, especially those with tighter margins, to borrow more just to cover the basics.
Okay, fourth hidden hand, commodity markets. This is about the prices you actually get for your products. They swing wildly, and that affects your ability to pay back any loans.
Absolutely. That Open Markets article showed it clearly. Corn, soybean, wheat futures, prices dropped a lot from their 2022 highs.
Changed the whole outlook for profitability pretty fast.
It really did. And that price volatility connects directly to managing debt. If prices fall, your cash flow gets squeezed, makes it harder to meet those loan payments, even if your interest rate hasn't changed.
Good point. And we should remember FarmDoc Daily's rate analysis didn't factor in why the loan was taken out or the specific terms or the borrower's risk profile.
Right. But all those things are heavily influenced by commodity markets, right? What you expect to earn really matters for loan terms and risk assessment.
Alberta.ca also mentioned the cost of holding inventory.
Yeah, the interest expense, while you wait for better market prices, that can eat into profits significantly. Timing your sales is crucial, but financing that stored grain or livestock costs money.
All right, fifth hidden hand, risk and insurance. Farming's risky weather, disease, markets, we know that. But managing risk costs money, like insurance premiums, and that can affect borrowing needs too.
Definitely. And Alberta.ca talks about interest rate risk itself. If rates jump unexpectedly, your interest costs are higher than planned.
Especially with variable rate loans.
Exactly. That directly hits your bottom line. It highlights the risk in borrowing itself.
Open Markets had some practical advice on this, quoting Steve Georgie.
From Allendale, yeah. Know your break-even costs. Lock in profitable sales when you can.
Which helps keep operating loans down. That's risk management, especially important when rates are higher.
Makes sense. Open Markets also mentioned using options to hedge risk around planted acreage.
Financial tools to manage price swings.
Right. But those tools have their own costs, which again, you have to weigh more carefully when money's more expensive to borrow.
And Produce Pay mentioned their trade protection service.
Yeah, vetting buyers and sellers, monitoring deals. It's not insurance exactly, but it reduces the risk of a deal going bad. Probably has a fee, but could prevent bigger losses.
Okay, so those are the 5 main hidden hands, but you mentioned a bonus insight.
Yeah, something extra for you listening today. Hedging interest rate risk. It's like hedging commodity prices, but for your loan costs.
Protecting yourself from rising rates.
Exactly.
Yeah.
Especially, as Alberta.ca noted, if you have variable rate loans.
So what's the main strategy?
Well, the simplest one, also from Alberta.ca, is just locking in a fixed rate when rates seem low. Gives you certainty on your borrowing costs, no nasty surprises later.
That makes sense. Get predictability.
It's the fundamental approach.
No.
But, there are more complex tools out there too. Our sources didn't detail them, but things like interest rate swaps or caps exist.
More advanced stuff.
Definitely. Probably not for day one, but as your farm grows, if you have significant variable debt, looking into ways to manage that interest rate exposure could be really important for long-term financial health, especially if rates stay volatile. Something to keep in mind down the road.
Okay, so wrapping this up, we've looked at 5 big hidden hands. Land, loan, leverage.
Equipment finance.
Input inflation.
Commodity markets.
And risk insurance. And you can see how they're all kind of tangled together.
Yeah, they really are. And they all have a big impact, especially if you're newer to farming.
So understanding borrowing costs, understanding interest rates, it seems more critical than ever right now in agriculture.
Absolutely.
Yeah.
You really need to grasp this stuff.
So the advice is be proactive. Research your financing options. Compare terms from different lenders.
Definitely shop around, like Farm Doc Daily said. It can make a real difference.
And build solid financial plans, which Produce Pay emphasized too.
It's foundational.
So maybe a final thought for everyone listening. As you start or grow your farm, just remember that mastering these financial forces, these hidden hands, can be just as vital as mastering the farming itself.
That's a great way to put it. So the question becomes, what steps will you take starting today to get a better handle on your farm's financial future? Keep digging into those resources. Keep asking questions.
We hope this exploration has been valuable. Thanks for joining us on the Deep Dive.
Hitting that like button and smash that subscribe.